All right, so this is part two of the exam review for Intermediate 2, Exam 3. And we've got some information here. In 2017, it says sales on account are $645,000. Warranty expense and the associated liability are $125,000. No other expenses are incurred. And then in 2018, we have sales on account are in the amount of $225,000. Warranty repairs are made in the amount of $65,000, and no other expenses are incurred. Prepare the journal entries for 2017 and 18 to record the sales, warranty, and income tax transactions. Assume a 40% tax rate. Okay, so we start out with the book. The book income is going to be the $645,000 minus the $125,000, and so that's going to be $520,000, and there is a 40% tax rate. And that will be $208,000. Now, that's the book. And then for tax, we have the 645. And remember, for tax purposes, we can't take warranty expenses until they're actually incurred. So we have a zero for the expense, gives us 645 times 40%. And that will be $258,000. All right. So our journal entry for 2017 is going to be tax expense, $208,000. And this will be income tax payable, and that will be $258,000. And so here we're going to have a deferred tax asset of $50,000. So that's 2017. All right, and so then in 2018, we have sales on account of $225,000, but we don't have a warranty expense here, right? Because when we do the warranty expense, when we do the warranty repairs, it will come out of the estimated warranty liability. And so we're just going to multiply that times 40%. And that will give us $90,000 of income tax expense. But here on the tax side, we're going to have the 225, but now we get to subtract the 65,000. And that gives us 160,000 times 0.4. And that will be 64,000. All right. Now remember, we are reversing the deferred tax asset. So here we're going to have for 2018, we will have tax expense, and that will be for the 90,000. And we will have income taxes payable, and that's for 64,000. All right. And so then to offset this, we're reversing the deferred tax asset. And that will be the difference between those, or $26,000. All right. So that is problem, the first of this problem for this exam. Okay, so number 23, Red Lantern Corp. reported a net deferred tax asset balance of $247,000, resulting from an estimated warranty expense accrual from book purposes. The enacted statutory rate related to this balance changed from 38 to 32, effective immediately. Prepare the journal entry to account for the change in tax rates. So we take the 247,000 and we divide it by 0.38. That means that the income difference, the warranty liability was $650,000. We now multiply that times 0.32. And that will be 208,000. All right, so now we need the difference between these two, and so that's $39,000 is the difference between the initial and the new deferred tax asset, as it should be. And so we write off tax expense for $39,000 and deferred tax asset $39,000. Now the question is, why is that tax expense? That's a good question. Why is that tax expense? Because we paid the tax earlier under the 38 and we don't get the full benefit of 38. We're only getting a benefit at 32. So we actually paid more than would be required on that. All right. So more than required if the tax regime and the book regime were in sync, right? Okay, so the next one up. All right, we can't actually do this one per se because we don't have an interest rate to work with, and so this was actually an old operating lease, and I'm not gonna do much with operating leases on your exam. All right, number 25, Stillwater Sports Company leased manufacturing equipment from Premier Leasing. The current year, Premier purchased the equipment for $326,189. The lease term is for 4 years, annual payments of $90,000. Life of the asset is 4 years. Fair value is $326,189, and the implicit interest rate is 7%. And so right now, we really don't have to, you've gotten used to going through the list of classifying a lease. We know right now that the lease term is 4 years and the life of the asset is 4 years. This is a capital lease, right? Okay, so, and so this is the leasee that we're doing. Stillwater Sports leased manufacturing equipment from Premier Leasing. So this is the leasee. It does not matter for the leasee if this is a sales type or a financing type lease. So what we do, we take the 90,000 annual lease payments, and we figure the factor. We get the factor of 7% for 4 years, and 7% of an annuity due for 4 years is 3.62432. And if we multiply that out, that gives us 326,188. That's just a rounding error from the fair market value, 188.80, so 189. So that is correct. The fair market value is the lease, the present value of the lease payments. So we're going to have a right of use asset, and that's going to be for the 326,189, and we will have a lease payable, 326,189. All right, so then part two, or the next one, is we're going to have to collect the cash, pay the cash, and so we'll write off 90,000 of the lease payable. And we pay it with cash. Okay, and then so then we come down to the end of the year, so 12/31, and we've got to do our interest payment. So 326,189 minus the 90,000 is 236,189. Times our implicit rate of 7%, so 0.07, and that will be interest expense for $16,533 and interest payable. $16,933. Don't forget our depreciation. So we're going to take the 626,189. We're told there is no expected residual value, so we simply divide that by 4, and we get 81,547. And accumulated depreciation, not depreciation, 81,047. All right, so that is it on this particular problem. And finally, our last problem. We have the Superbite Corporation sells photographic equipment. Superbite leases equipment to Laguna Madre Company on January 1st of the current year. The cost to manufacture the equipment was $12 million. Okay, so the lease is non-cancelable. There is no residual value or bargain purchase option. The lease term is 8 years. Payments are made semi-annually. So now we've got a little bit of a twist to this one, right? Depreciation is recorded on December 31st using straight line approach. Economic life is 8 years. So we know the lease term is 8 years, the economic life is 8 years. This is a capital lease. The lessee's incremental borrowing rate and the implicit rate are both 12%. Lease payments are $1,493,617 semi-annually. The first lease payment is due at the inception of the lease. Subsequent payments are due every July 1st and January 1st. Fair value of the equipment at the inception of the lease is $16 million. Record the journal entries that SuperBite will make for the first year of the lease. All right, so the first thing we need to do, so we're looking at, okay, so now we're looking at the lessor. And so now it does make a difference whether this is a sales type lease or a financing type lease. So the first thing we want to do is determine what the lease receivable is on that. So we're going to take the $1,493,617, and we need 12%, right? But just like we did when we were doing bonds, we're doing this semi-annually. So we're going to cut the interest rate in half. So that will be 6%. And we will double the number of periods. And so that will be 16. So looking at our time value of money tables for 6% interest for 16 years, we get 10.71225. And when we multiply that out, $15,999,999, essentially $16 million. So the fair market value is the lease value. All right. So now remember, this is the lessor that we're recording, not the leasee. So we are going to have a lease receivable for $16 million. And we're going to have lease revenue for $16 million. But we are also going to have cost of goods sold for $12 million. And we're going to have inventory for $12 million. All right, very good. We also have to have our first lease payment. And so that's going to be, we're going to get cash in, and that's going to be the $1,493,617, and we're going to write down the lease receivable by $1,493,617. Okay, so that takes care of the January 1st entry. Okay, so now we go to July 1. Okay, there's July 1, 7/1. Sorry, not 1/1. On 7/1, we're going to have interest I'm writing it like it was the lessee, right? We're going to have interest. Actually, we're going to receive cash since we don't make a adjusting entry here. We're going to have cash of the 1,493,617. We're going to have interest revenue, and that's going to be the 16 million minus the first payment we received, the 1,493,617. So we're financing 14,506,383. Now we're going to multiply this times 0.06. We can multiply it by 12 and then divide by 2. We get the same place. Multiply it by 0.06. And so our interest revenue is going to be 870,383. Subtract the 14,93617, and that gives us, we write down the lease receivable by 623,234. Okay, then on 12/31, we have to figure the interest on this. So it's going to be the 16 million minus the 1,493,617 minus the 623,234 equals 13,883,149 that we're financing, times 0.06, 12% for half a year, is 832,000. This time we're going to have interest receivable 832,989. Interest revenue $832,989. Now, remember, on a capital lease, and we are the lessor, we are selling this, so we do not have a depreciation entry. So for the first year's book entries, that's what we have. All right, so that concludes this. These are things that you very well could see on the exam. I'm not going to hit you hard with operating leases, just some multiple choice. So we will, good luck on the test. And between now and when you take it, feel free to email me and contact me and ask me any questions that you have. All right, good luck.